If you're over 50 right now and you're staring at your savings, maybe your old 401k, maybe some cash in the bank, and you're asking yourself, should I finally buy a house or should I put this money into stocks? The choice you make in the next year or two could shape the next 20 years of your life. I don't say that to scare you. I say it because I've watched people your age and mine make this decision very, very well, and I've watched others get trapped by it. I'm George Edward, and this is George Edward Explains. Around here, we talk calmly and honestly about money for people in their 50s, 60s, and 70s. And in this video, I'm going to walk you through the real trade-offs between buying a house and buying stocks, using simple real-life examples and very simple math, so you can make the right decision for you, not for your neighbor, not for your brother-in-law, and certainly not for some shouting TV guru. Before we go any further, if you're over 50 and you want someone in your corner breaking this stuff down in plain English, do me a favor. Hit that subscribe button and tap the little bell. That way you don't miss the next videos where we'll talk about things like turning your savings into income and avoiding the biggest retirement traps. And if you find this helpful, stick with me until the end. I've got a one-page exercise for you that can make this whole decision a lot clearer. Now let's start with a simple idea. There's an old investing line that goes like this. Price is what you pay, value is what you get. A house has a price, stocks have a price. But today is not about the sticker number. It's about what you actually get in your life over the next 10 to 20 years. We're going to look past the price tags and really see the value, the stability, the growth, the flexibility, the stress level, even the sleep you get at night. To make this real, I want to tell you a story about two people who might sound a lot like you or someone you know. Tom is 58. His wife Linda is 56. They're good people, worked hard all their lives. Tom was in manufacturing, then later in a warehouse job. Linda worked part-time in a medical office. The kids are grown and out of the house. They're renting a nice little two-bedroom place in a decent neighborhood. Nothing fancy, but comfortable. They've got some savings, not as much as they wish, like most of us. Tom's got an old 401k from a job he left 15 years ago, just sitting there. A few IRAs they opened along the way. They're not broke, but they're not rolling in money either. They're in that in-between place where a mistake could really hurt and a good decision could really help. Every morning, Tom sits at the kitchen table with his coffee, scrolling through home listings on his tablet. He sees this one house, 3 bedrooms, a little yard, older place, but nicely kept. And his eyes just light up. He's thinking, this is it. I'm almost 60 and I've rented my whole life. I want something that's mine. I want to paint the walls the color I like. I want to say, this is my house. He hears friends at church saying, you're throwing money away on rent. This house is a great investment. You've got to grab it. While he's doing that, across the table, Linda is looking at a different screen. She's logged into their retirement accounts. She's watching the numbers, doing the math. She's thinking about their budget, their health, the cost of everything creeping up. And one night she says, Tom, if we put almost everything into this house, the down payment, the closing costs, the furniture, what's left to grow for our retirement? What do we live on when we're 75? So you've got this tension. On one side, the house feels solid. You can see it, touch it, walk through it. It's emotional. The porch, the kitchen, the grandkids visiting. On the other side, you've got stocks. You can't see or touch them. They live in some account on a screen. They feel invisible, and if you've been through crashes, they can feel scary. But they also have this quiet, powerful ability to grow over time. There's another line I love that goes like this. The big money is not in the buying and the selling, but in the waiting. That's the real heart of Tom and Linda's struggle. They're not really asking a house or stocks. They're asking, if we're going to wait 10 or 20 years, what should we be waiting in? Bricks and a roof or pieces of businesses? And most importantly, which one will reward our patience and give us more freedom later? I'll tell you what Tom and Linda decided a little later because what they did might surprise you. But first, let's slow this down and talk about what a house really is and what it is not, especially after age 50. When you're over 50, a primary home is, first and foremost, shelter. It's a roof over your head and hopefully stability. If you own it, you don't have to worry as much about a landlord selling the building or kicking you out at the end of the lease. Emotionally, it can be huge. There's comfort in walking into a place and saying, this is mine. For some people, that feeling is worth a lot. A home you own can also be a kind of shield against rising rents. If you lock in a fixed-rate mortgage, your principal and interest payment stays the same while rents around you might be going up. That can feel very reassuring when you're on a fixed income later on. So in that way, a home can provide stability and predictability, important words as we get older. But here's what a primary home usually is not for most people. It is not a cash machine you can easily live off in retirement. You can't just pull off a bedroom and sell it to pay for groceries. To get money out, you usually have to sell the whole thing, take a loan against it, or set up something like a reverse mortgage. And each one of those comes with costs and complications. It's not quick money either. Buying and selling a house is expensive and slow. You've got closing costs when you buy, and then when you sell, you've got real estate commissions, more closing costs, maybe repairs you have to do to get it sale ready. And you can't control when the market is up or down when you're finally ready to move. If you need to sell in a bad year, that great investment might not look so great. And it is definitely not a perfectly predictable return. Neighborhoods change, properties age, taxes go up, insurance changes. A city puts in a highway near your quiet street. The factory 3 miles away closes. There are a lot of moving parts. Let's talk about some of the hidden costs. Maybe you've lived through some of these. Property taxes that creep up year after year, insurance that goes higher after a storm in your area, that roof that looked fine when you bought the place, but 5 years later, a leak starts and suddenly you're looking at $8,000, $10,000, $12,000. Or the old plumbing that decides to give out the year you turn 67, or the HVAC system that dies in the middle of July. None of those show up in the simple rent versus mortgage comparison people like to do. I remember a woman I knew, late 50s, who bought her dream downsized home. The mortgage payment was only a little more than her rent had been. She thought she'd made a smart financial decision. 2 years later, the county reassessed her property and her taxes jumped. Then her insurance company changed its risk calculations for the region, and her premium nearly doubled. Then the water heater went, then the dishwasher. None of those things alone broke her, but together, let's just say the dream created more stress than she expected. Now, renting after 50 isn't perfect either. The big downside is uncertainty. The landlord can raise the rent. The building can be sold. You might have to move more than you'd like. That's no fun in your 60s. You might also feel like you're throwing money away, even though you're actually paying for something useful. A place to live, with someone else dealing with the roof and the plumbing. On the plus side, renting gives you flexibility. If your health changes or your kids move to another state and you want to follow, or you realize you don't like the climate, you can move more easily, and you don't have to tie up a big chunk of your savings in one property. That flexibility can be a kind of safety. So picture this. A single house is like one needle. It might be the right needle. It might not. But it's just one. Then think about a broad stock index fund and something that owns thousands of different companies in one package. That's like owning the whole haystack. There's another old line that goes, don't look for the needle in the haystack, just buy the haystack. When you buy one house, you're making a big bet on one location, one local economy, one street. When you buy a broad stock fund, you're spreading your bet over a whole lot of different businesses and parts of the economy. So where does that leave us? Let's talk about what stocks, especially through simple index funds or ETFs, really do for you after age 50. When you own stocks through a fund, you're not owning little paper tickets in a casino. You're owning tiny pieces of real companies. Companies that make food, medicine, technology, clothing, energy. Companies that build roads and run software and transport goods. Companies that other people use every single day. When those companies raise their prices over time, or sell more stuff, or become more efficient, the value of your little piece, your share, can grow. Many of them also share their profits with you in the form of dividends. Those little checks or reinvested amounts can add up over the years. Why does this matter so much after 50? Because from 50 to, let's say, 80 or 90, you've got a long battle with inflation. Groceries, medical costs, utilities, they don't sit still. If your money just sits in the bank, earning almost nothing, prices walk away from you. You feel poorer every year, even if the dollar amount doesn't change. You need at least some money working for you, growing faster than inflation, to protect your future self. There's another big word here, liquidity. That just means how easy it is to get to your money. Money in a house is like water frozen into a big block of ice. Yes, it's water, but it's stuck in one solid shape. To get at it, you need tools. Selling the house, getting a loan, signing a lot of papers. Money in a stock fund is more like water in a jug. If you need some, you can pour out a little without having to move the whole jug across town. You can sell some shares, leave the rest invested, and adjust as you go. Now, stocks have their own problem. They go up and down every day. Your account balance can change by thousands of dollars in a bad week. That can be uncomfortable when you're not adding new money like you did in your working years. A house moves in value too, but you don't see the price every day on a screen. In your mind, it feels more stable because nobody is calling you saying, Your house is down 3% this week, but that doesn't mean it's not going up and down. You just see it less often. This is where that other saying comes in: know what you own and know why you own it. If you own a house, know that you mainly own it for living, for shelter, for stability, for your sense of home. If you own stocks, know that you mainly own them to grow your future money, to give yourself more options, to keep up with rising costs. When you're clear on the why, it's easier to ride out the bumps. So let's put all this together into something you can actually use. Instead of one right answer, I'm going to give you a simple 3-question framework. These questions can guide you towards your answer. First question: what's your current housing situation? If you already own a home that's paid off or very close to paid off and you like where you live, your priority might not be buying more property. In that case, your shelter is pretty secure. For you, the bigger opportunity might be taking your extra savings and putting them to work in investments, so that home is not your only asset. If you're renting, but your rent is stable and affordable, and you're not lying awake at night worrying that you'll be kicked out, there's no rule that says you must rush into buying. In that situation, it might make more sense to keep building your investment accounts first, especially if they're small. If you're in an area where rents are rising quickly, housing is tight, and you think you'll stay there for 10 years or more, maybe you've got grandkids nearby or your doctors and community are there, then owning a modest place might make a lot more sense, as long as the numbers don't crush your ability to keep investing. Second question: how strong is your retirement investing right now? If you're over 50 and your investment accounts are very small, maybe most of your savings would go into the down payment and closing costs on a house, then you're at real risk of ending up what I call house rich and retirement poor. You might have a lovely home, but not enough money to fix the roof or pay for medical expenses or travel or just enjoy life. On the other hand, if you already have solid investments, maybe you've got a decent 401k, IRA, or brokerage account, and you're still adding to it, and what you really need is housing stability, then buying a home can make sense. The key is that the house shouldn't wipe out all your cash. You still want an emergency fund. You still want to be able to invest something each month. Third question: how long will you stay, and what's your health like? If you're pretty sure you'll stay put for 10, 15, 20 years, and your health is reasonably good, then a house can be a reasonable part of your plan. Over that kind of time frame, the buying and selling costs get spread out, and you get to enjoy the stability along the way. But if you're not sure where you'll be living in 5 to 10 years, maybe your kids are moving around a lot, or you're thinking about another state for lower taxes, or your health is a bit shaky and you might need to be closer to certain care, then tying up a huge chunk of money in a house might be risky. In that case, flexibility, which you get more from renting and from having liquid investments, might be safer. There's a line I repeat a lot to people: the individual investor should act consistently as an investor and not as a speculator. Buying a house just because everyone says it's a good investment, or because my buddy made a killing on his, that's closer to speculation. Sitting down, asking yourself these 3 questions, looking at your numbers, and making a calm choice, that's investing. Now, even with a good framework, a lot of people over 50 fall into the same traps. Let's talk through some of the big mistakes, not to scare you, but to help you avoid them. The first mistake is going all in on the house. This is when someone takes almost every dollar they have, savings, retirement money, sometimes even borrowing from their 401k, to cover the down payment, closing costs, new furniture, and just a few little upgrades. They move in, it feels great, and then the car breaks down, or there's a medical bill, or they lose a job, and there's no emergency fund, no extra investments, nothing to fall back on. One surprise can turn into serious trouble. The second mistake is ignoring the real monthly costs. A lot of people only compare their rent with the mortgage payment. My rent is $1,800. The mortgage would be $1,900. That's just $100 more, and I'm building equity. But they forget the property taxes, homeowners insurance, maybe a homeowners association fee, and the ongoing maintenance, yard work, repairs, things that break in a house that an apartment landlord used to handle. Add all that up, and that $1,900 mortgage can feel like $2,400 or more. The third mistake is treating the house as the only retirement plan. I hear this a lot. We'll just sell the house later and that'll fund our retirement. Okay, maybe. But what if the housing market is down when you're ready to sell? What if interest rates are high and buyers are scarce? What if you emotionally don't want to leave that house when you're 75? You might be trapped in an asset that looks big on paper but doesn't easily turn into the income you need. The fourth mistake is the opposite extreme, being 100% in stocks with no plan for housing stability. If you're in your 50s or 60s renting and all your money is in the stock market, but you're in an area where rent could spike and you have no backup plan, that's risky too. You don't want to be forced to move every couple of years in your 70s because landlords keep raising the rent. Stability has real value. The fifth mistake is letting salespeople make the decision for you. Realtors, mortgage brokers, even some financial advisors, and many of them are good people, but they're paid when you take action, buy a house, take out a loan, roll over an account. They don't live with the consequences of your choices you do. So when someone is pushing buy now or making you feel like you're missing out, slow down. There's a saying that goes, it's only when the tide goes out that you discover who's been swimming naked. When everything's going well, job is steady, markets are up, housing prices are climbing, it can feel like any decision works. But when something goes wrong, that's when you find out whether you were overstretched on a house or underinvested for retirement, or both. The goal here is to make sure that when the tide goes out in your life, in a recession, an illness, a change in the family, where you're not the one caught exposed. So what can you actually do this week, not someday, to get clearer on whether a house or stocks, or what mix of the two is right for you? First, sit down with a pad of paper or a simple spreadsheet and list your real housing numbers, not the dream numbers, the real ones. Write down what you pay now, rent or mortgage plus taxes and insurance if you already own. Then take a realistic look at what owning would cost in your area. That means the mortgage payment if you bought a modest place, plus property taxes, homeowners insurance, any HOA fees, and a reasonable estimate for maintenance each year. Some people use 1 to 2% of the home value per year as a rough guide for maintenance, especially on older homes. Compare those totals honestly, not in your head, on paper. Second, list your retirement investing numbers. How much do you have in your 401ks, IRAs, and brokerage accounts? Add them up, then ask, how much am I adding to these each month right now? $50, $500, nothing? And then the big question, if I buy a house the way I'm imagining, what happens to these numbers? Do they keep going up each month, or do they freeze, or even go backwards because I have to pull money out? Third, decide your top priority for the next 10 years, not for next month, for the next decade. Are you more in need of the stability of a home you own, knowing that your housing situation is locked in and you're not at the mercy of a landlord? Or are you more in need of faster growth and flexibility from investments, building up a pot of money that can support you wherever you live? There is no universal correct answer here. There is, however, a right answer for you once you're honest about your numbers and your life. Fourth, and this is important, run your thinking past a neutral person. If you can, talk to a fee-only financial planner, someone who gets paid for advice, not for selling you a policy or a mortgage. If that's not an option, find a wise friend or relative who's good with money and who doesn't stand to gain a commission either way. Lay out your numbers, show them your notes, ask them to poke holes in your plan, not to make the decision for you, but to test it. I want to leave you with one more line that I keep close to my heart. It goes, you only have to do a very few things right in your life so long as you don't do too many things wrong. When you're over 50, you don't have to make the perfect move. You don't have to guess the exact best stock or buy the exact best house or time the market. You just have to get a few big things roughly right and avoid the worst mistakes. Getting this one decision roughly right, house or stocks, and in what balance, can be one of those very few things that makes the rest of your life much easier. For some of you, that will mean staying put in a rental a bit longer while you build up your investments. For others, it will mean buying a modest, affordable home and continuing to invest steadily on the side. For some, it might even mean selling a too expensive house, moving to something smaller, and using the difference to fund a stronger investment plan. Remember Tom and Linda? After we walked through these questions and wrote down their numbers, they realized something surprising. They didn't actually need the big 3-bedroom house they'd been eyeing. What they really wanted was a sense of home and stability and enough money growing for their later years so they wouldn't be a burden on their kids. They ended up buying a smaller, more affordable place than the one their friends were raving about. Their payment, including taxes and insurance, was not much more than their rent had been. They kept a solid emergency fund in the bank. And this is key, they committed to still putting money into their investment accounts every single month. Was it glamorous? No. Were they trying to hit a grand slam? No. But step by step, they built both stability and growth. And 10 years later, they were very glad they didn't go all in on the dream house that would have choked their future. If you're still with me now, that tells me something important. You care. You're willing to think. to plan, to act like an investor, not a speculator. And I want to encourage you, it is not too late in your 50s, 60s, even 70s to make smarter financial moves. You have experience. You know what matters. You don't need perfect. You just need better decisions from here on out. So here's what I'd like you to do next. In the comments below, tell me where you are in this decision. Are you leaning toward buying a house, staying a renter, and focusing on stocks? Or do you already own and you're trying to figure out how much to keep investing? You don't have to share dollar amounts if you don't want to. Just share your situation. I read those, and they help me know what videos to make for you next. If this video helped you see things more clearly, please hit the like button so more folks your age can find it. Share it with a friend or a sibling who's struggling with the same house versus stocks question. Sometimes just watching the same thing and talking it over together can lead to really good decisions. And if you haven't yet, make sure you subscribe to the channel, George Edward Explains, and tap that notification bell. In upcoming videos, we'll talk about how much you really need to retire, how to turn your nest egg into income you can't outlive, and simple ways to invest even if you feel like you're late to the party. You and I can't control the market. We can't control housing prices, but we can control how we think, how we plan, and how we act. Take a deep breath, get your numbers on paper this week, and give yourself credit for taking this seriously. Your future self, 10 or 20 years from now, is going to be very grateful for the steps you start today. I'm George Edward. Thanks for spending this time with me. I'll see you in the next one.